What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown. If you pay attention to financial news at all, you've probably seen recently some attention focused on a new way that companies are using to go public with their company, sell shares, sell ownership of their company to the public, and it's called direct listing. This is different than the traditional way, which is just to IPO, and it's also different than one of the other new ways to go public, which is through a SPAC. Now, a company that is gaining a lot of attention recently for going public through a direct listing is Coinbase. And if you want to know all about the whole situation with Coinbase right now and its executives selling or dumping a ton of their shares on opening day, check out my video on Coinbase right here. But due to some recent regulatory changes by the SEC, we are expecting to see a lot more direct listings going into the future. They just made it a lot more easy for companies to be able to do this. And so what we're going to look at today is what is a direct listing and how does it differ than a traditional IPO. And we'll also look at SPACs a little bit as well, because that's another way companies are going public now, so that you can make a more educated decision about a company, whether you want to buy a stock or not that has gone public through either a traditional or one of the new ways that companies are deciding to sell some of their shares to the public. Ready? Let's dive in. All right, so we've got IPOs, direct listing, and SPACs. So I'm going to give you an analogy here that'll get you about 90% of the way there of understanding what the differences are and how they work without any of the technical mumbo jumbo. Let's say you've created a brand new product. It's a fantastic product. It's a phone case with a mirror on the back. It's for people who want to take selfies with the main camera on their phone that is much better than the front-facing camera where the screen is, but you can't normally see where your phone is pointing when it's, turned around. And so you throw a case on your phone with that mirror on the back. That way you can make sure it's facing directly at you when you're snapping those selfies. You have two choices with your new product. You can sell your product directly to consumers. You can create a website, you can start to market it, throw up advertising, buy some billboards, start calling up celebrities to try and endorse your product. And when people buy it, you have the product, you create it, you ship it directly to the customer. Your margins are going to be pretty high, as high as they can be, because you're just selling it directly to the consumer. No middlemen, but the risks are that you can't actually get it to sell, and you go through all this work, you spend a bunch of money on creating the product and setting up the infrastructure to ship it out, and maybe the money you spent on advertising, and you don't sell enough to recoup your costs. So a little bit higher risk, higher reward. That's a direct listing. Now your other option is to go to a company like Walmart or Costco, and you say, hey, I've got this great product. I want you to sell it in your store, and I'll give you a great deal on it because you're buying, a couple million units from me, and then you can mark it up and sell it to your customers. Now this is more akin to a traditional IPO. You're going to these companies and you're saying, hey, I want you to buy a bunch of units of my product, and then the risk is on you. It's on you, Costco. It's on you, Walmart. And so you just sold the product to Costco or Walmart. You made a ton of money because they bought a ton of your products. Much lower margin, though, because you had to give Costco and Walmart the ability to sell them at a higher price. But it's low risk for you because you just sold a massive number of units that you may not have been able to sell if you had tried to do it without any middlemen. Now, third option is a SPAC. That's the third way that companies are going public, and this would be like your product is it's a mystery box. So you sell a mystery box and you're going to ship this box to somebody, and they have absolutely no idea what is going to be in this box once they get it. They're paying a specific amount for this box, and then once they order a box from you, you turn around and you just go buy an assortment of other things that you put in the box and ship it to the customer. And you just hope they like what they get. So now let's break it down a little bit more into the details here. With an IPO, like I said, you're using a middleman, and when you go public through an IPO, you're using an investment bank, you're using an underwriter. And so the company, they're a private company, they'll go to an underwriter and they'll say, hey, we want to go public. And so the underwriter then will create a bunch of new shares. Now, when you create a bunch of new shares that didn't exist before, that does dilute the value of all previously existing shares. And then the underwriter usually comes up with some sort of agreement that says, hey, if a certain number of these don't sell, we we will take the financial responsibility to buy the rest of them at a certain price. And so the underwriter is taking on a ton of risk there because they're saying, hey, if nobody else wants these shares, we are going to be the ones that buy and hold them, and then they'll sell them as they can. Now, for the risk that this underwriter is taking on to do all the work, the financial, the paperwork, the legal work to make this listing happen, to take this company public, they're going to charge 3 to 7% per share that's sold. And so they get a massive, sometimes hundreds of millions of dollars when you consider how many shares are actually being sold. And it's a significant percent of the money that is raised goes to the underwriter. So the way that the underwriter then gets these shares to sell is they go around and they do this whole campaign, and they go to all their partners, they go to all the different companies that they know, all the mutual funds, insurance companies, investors, institutions, and they say, hey, we're going to be taking this company public. Here's what it looks like, and we value the company at this much, and so we're trying to get everybody to buy as many shares as possible at this price. And so for the company that's going public, the risks are obviously you're going to have dilution of your shares, right? So that's number one. And number two, you're right off the bat sending a significant percentage of the money raised just to the underwriter as a thank you for taking you public. And finally, there are lockup periods through the traditional IPO process that executives and insiders cannot sell their shares or a significant percentage of their shares for 180 days. So there are lockup periods involved so that the public and everybody else that the underwriter gets to buy shares, they're not getting swindled, because the big boys don't like to get swindled and taken advantage of. And so they say, hey, if we're going to buy these shares, we're going to give money to the company, we don't want the insiders and the executives dumping all of their shares on us and crushing the value of the shares that we just bought. So we want to make sure, at least for a couple of months, you guys all have to keep your shares. And the vast majority of companies that go public do so through this traditional IPO process. Now, like in the example I gave of the product that you developed, selling it directly to consumers, a direct listing is where you do not use an underwriter to go public. Instead, you're going straight to the exchange and you're listing your shares directly on the exchange. Now, obviously, there are some benefits to the company for this. Number one, you don't have to pay 3 to 7% to an underwriter. So any amount of money that's raised from selling ownership of the company to people who want to buy it comes directly back to you as the company. And so you don't have to pay that commission. Now, obviously, there are risks as well, right? Because if the company decides to do a direct listing, there's nobody standing by saying, hey, we're going to buy a certain number of shares guaranteed. And so if the public doesn't want them, we're going to step in and provide a floor underneath the share price. And so since there's that risk for the company selling those shares, they throw a bunch of shares onto the market and nobody wants them and the price just falls, that's also a risk on the new investor who comes in and buys shares, because there's no underwriter, again, protecting giving a floor to that price. And so it makes it a little bit more dangerous for a new investor, a small investor, to come in and buy shares because nobody's providing a floor. And so that could provide less demand for a direct listing. Now, finally, and here's one of the biggest dangers and red flags for direct listings. There's no lockup period for insiders and executives on when or how many shares they can sell. Now, this is what Coinbase is currently, they're in a lot of hot water for right now. And again, if you want to watch my video on the Coinbase direct listing, it's linked in the description below. But if a company decides to do a direct listing, there is no limitation on who or how many shares can be sold by insiders and executives. Now, there's some great companies that have gone public through direct listing. So just because a company is choosing the option to do a direct listing doesn't mean it's shady, and it doesn't mean it's obviously or destined to be a bad company. Spotify did a direct listing, Asana did a direct listing, Palantir did a direct listing, now Coinbase, and there are some other companies as well that are planning or allegedly are rumored to be doing a direct listing at some point in the near future. Companies like Instacart and Roblox. And as the direct listing option is easier, it's cheaper, there's less paperwork, even though it's higher risk, in this environment, I would expect that we would see more and more and more direct listings, in the same way that we've seen many more SPACs come out of the woodworks in recent years. And finally, the details on SPACs. Like I said, if you were selling a product, it'd be like selling a mystery box. A SPAC is a company that goes public, and it's also called a blank check company. When they go public, there's no business. They're just raising money with the sole purpose of, within a given time frame, they're going to take all that money that they raised and buy a different company. So they form this company out of thin air, create a bunch of shares, sell those shares to the public, and then let's say they raise $5 billion. They're going to take that $5 billion and they're going to go shopping and they're going to look in the private markets. They're going to look for private companies that are not public yet, and they're going to buy those companies. If they don't purchase a company that fits the requirements of how the SPAC is set up, within the allotted time frame, they have to dissolve the company and return all the cash to the shareholders. However, if they do find a company, what they'll do is they'll take all that cash, they will go buy that private company, and it'll basically just be a merger. And so it's a tool for private companies to be able to go public by getting bought out by an already public company that only went public as a blank check company. It wasn't publicly traded company, as it wasn't doing anything of business value except looking for a private company. Now, the advantages to the company for going public through something like this is that basically the regulations on what's required is minimal compared to the traditional IPO process. And so if you're a company that gets bought out by a SPAC, you're able to go public. And maybe if you tried to go public a different route through a direct listing or a traditional IPO, you would have never been able to make it through all the regulatory hoops. And it could be for a variety of reasons. And again, it doesn't mean that a company that goes public through a SPAC is a bad company. There are plenty of great companies, but it does open up the door for more fraud. And as we have easy monetary environments, what you tend to see is it makes it easier and easier for more and more money to pile in to all sorts of new volatile and exotic investment vehicles. And then when the tide goes out, then you find out who's been swimming naked. And right now the tide is in full force. And when waters start to get choppy again, we're sure to see more frauds that will make Charles Ponzi and Bernie Madoff look like child's play. So that's IPOs and direct listings and SPACs. Thank you so much for watching. If you enjoyed the video, please hit that like and subscribe button. Really appreciate you guys. Thanks for watching. Have a good day.